Okay, folks, it's time. Let's get started. Any questions before we start? Now that we've got the first quiz behind you. Now, my suggestion is that you take this moment of grace after the first quiz before you start thinking about the second quiz and start to get your first try at your DCF on your company, because you have all the ingredients you need. Talked about cash flows, we've talked about discount rates, growth rates, terminal value. In fact, today we're going to talk about what I call the loose ends in valuation. And rather than be mysterious, let's start at the start of the class test. You're going to see what I mean by this. So let's say an analyst is looking at a company. The company has a big cash balance. A lot of companies do have big cash balance, right? Google has 100 billion, Facebook has 80 billion, Apple has 150 billion. And the analyst notices that the cash is invested in T-bills and commercial paper, which it has to be called cash and marketable securities, liquid and riskless. And it's earning close to nothing, 0.05%. So I'm going to play the role of the analyst, and I want you to tell me what I'm saying. This is a terrible investment for the company to make. It's investing in something that makes almost no return, and its cost to capital is 7, 8, 9%. You see where I'm going? Cash is a wasting investment, I'm arguing, because it's earning well below the cost of capital. If that is true, then every company that holds cash is destroying value because it's holding cash, right? What's wrong with my argument? What am I missing when I say cash is a wasting asset because it earns a return lower than the cost of capital? Morris, what do you think? What am I missing when I just compare what cash is making to my cost of capital? You're still muted, Morris. I can't hear you.
Oh, sorry. I was just gonna say that, like when you have cash, you're liquid.
Liquid and riskless. So what should I be comparing the return on cash to rather than the cost of capital?
The risk-free rate.
In fact, the risk-free rate on something liquid and riskless, right? Which would be the risk-free rate, what I would earn on a 3-month T-bill or a commercial. Yeah. And right now, guess what I'd earn on that? Close to nothing. Cash is not a wasting asset. It earns a low rate of return, but a rate of return that is the right rate of return given the fact that it's riskless and liquid. So today we're going to talk about cash. We're going to talk about the conditions that might lead you to discount the cash in the hands of a company. And this is one of the reasons. We sometimes punish companies for holding cash. We're going to talk about why. But don't make it be because they earn a low rate of return. We're also going to talk about cross-holdings. And cross-holdings are a mess. So Rebecca, I'm going to ask you a question. And this is about where cross-holdings show up in a financial statement. Along the way, we're going to see the key question that's going to drive how we think about these loose ends. Let's say company A owns 60% of company B, and its financial statements are consolidated. I'm going to let you, kind of work through what consolidated means. If I use company A's financial statements to value company A, in other words, I take the operating income from its income statement, the tax rate, the cash, the debt, and I value company A, how much of company B is already in my value? They own 60%, but I'm using consolidated statements. When I finish my valuation, how much of company B is embedded in my value?
60%.
You'd like it to be 60%. I would too. But what does consolidated mean? What are you required to do when you consolidate?
You like put them together.
And you have to act like you own 100%. It's one of the crazy things accountants make you do. So when you count the operating income, you're not just getting 60% of company B, you count 100%. When you look at debt, you're counting 100%. So when you're finished with evaluation, guess what? You actually have 100% of company B in your value, but you own only 60%. So what's the cleaning up I have to do after I finish my valuation to get to my true value? I need to subtract out the 40% that doesn't belong to me, right? In company B, because I've counted it. We're going to talk about that today. When you have consolidation, there's cleaning up to do after the valuation because you've overcounted. Now let's take another example. You can help me out here. Company A owns 10% of company B, and it's treated as a minority passive investment or minority active investment. That's a minority investment. You finish your valuation, okay? How much of company B is going, so you take free cash from the firm, discounted the cost of capital, you come up with the value. How much of company B is in that value?
In this case, would it just be 10% of company B as minority
You'd like
interest?
it to be 10%. Both you and Rebecca are saying the sensible thing. If I own 60%, I want it to be 60%. If I own 10%, but the problem is the accounting gets in the way. You know what accounting makes you do when you own 10% of a company? You take the income from that 10%, you have to show it below the operating income line. You see why that matters? When you did free cash flow to the firm, what did you start with? You started with the operating income. So when you use the operating income and the cash flows, those cash flows don't reflect the 10%. So guess what? When you're done, you haven't counted any of company B. And to clean it up, what do you have to do? You now have to value company B and add the 10%. Cross holdings are the messiest part of valuation. You can already see why, right? If you have a majority holding, which is what you had with the 60%, you got to clean up for the minority interest that doesn't belong to you. If you have a minority holding, you got to clean up by adding the value to the holding. And if you're not careful about the signs, you can already see very quickly that you can end up in the wrong place. Which leaves me with one final question. And Sebastian, you're going to help me out here. So you take free cash to the firm, you discount the cost of capital, you finish with the value with the valuation, but then you decide to take a look at the balance sheet to see if there's something you might have missed. So I'm going to start listing items of the balance sheet. And you tell me whether you will add this on to the value that you already got with the DCF. So you've got cash flows, you've discounted, you've got a present value. And you look at the balance sheet and they tell you that they own their headquarters building in New York. It's worth $500 million.
I would add that.
You would add that?
It's a tangible.
Who sits in the headquarters? Who's in that headquarters building? Your employees, right? What are they doing all day? Hopefully something productive. And while they're doing something productive, they're selling stuff, basically, do you see where I'm going? Those people in the headquarters building are generating revenues and earnings and cash flows, which you've already counted in your free cash flow to the firm. If you count the cash flows and you count the headquarters building, you see the risk you run? You might be double counting. If they own vacant land in New York, then the answer could be different because that land is not part of your earnings and cash flows. You say, I own a half an acre in the middle of downtown Manhattan. That's going to be added back because that is something that doesn't add to earnings and cash flows. Here's the question I'm trying, I would like you to think about any time you think about adding or subtracting. Ask yourself, what have I already counted in my cash flows? Because you want to make sure you don't double count.
I have a question.
So Jake, go ahead.
But that, if they own that building outright, in the event of liquidation or something like that, that's still an asset to the firm.
So even if liquidation valuation, a liquidation valuation and a DCF don't live together. What's the essence of a DCF?
Future cash
flows.
A
going concern. So if you want to do a liquidation valuation, that's different. Then I can say, because then I'm not selling the employees with the building, right? I'm not going to keep the cash flows, I'm liquidating. So you're absolutely right. And that's one of the ways we're going to separate liquidation valuation from a going concern valuation. So the liquidation valuation, that's exactly right. You would be selling the building, you'd be getting the real estate value for the building, as opposed to the going concern value you got in your DCF. So Jake, you're going to be on the next one. Patents. A pharmaceutical company owns patents. You see that on the balance sheet. Should I add the value of the patents to my DCF value?
I believe so. I think you should price it as an option.
What's the question I said you should ask? Have I counted it already, right? So how do you get the DCFs? You had earnings and a growth rate. And when you did that, did you...
Oh, yeah. Would that be included in the growth rate so you wouldn't count it?
You did it, right? And you should know, right? Because then you said, I used a 20% growth rate because of this great patent for the next 15 years. It's already in your growth rate and cash flows. Adding the patents would be double counting. Parth, I'm going to give you the easy one. You're a consumer product company. The accountants have managed to put a number on brand name and put it on the balance sheet as an asset. Should I add the value of a brand name? to my DCF?
I want to say no, because that's how you got your cash flows from actual consumers.
If I asked you where in your cash flows is brand name, what would you point to?
Sales.
And margins.
Mhm.
And in other words, every number in your cash flows reflects the fact that you have a great brand name, right? To add brand name value would definitely be double counting. Sriram, here's the easiest one of all. I see goodwill on the balance sheet. What should I do about it?
My guess is nothing.
And why? Your guess is right. Why? What does goodwill measure?
It's like
Absolutely nothing. I'll save you the trouble. It measures absolutely. It's a plug variable. It exists because you want your balance sheet to balance. It is the most useless item on the balance sheet, right? You might as well call it X. Definitely don't be adding goodwill to a DCF valuation. Final one, and this is a kind of a offbeat one. Your CEO loves Picassos. So you know what he's been doing? He's been taking the company's money and he's been buying Picassos every year for the last 10 years. And Picasso could be worth 100 million. 10 Picassos could be worth $1 billion. Should I add that value on to my DCF value? Chad, you're nodding yes. Why should I add it? Because you're right. I should be adding it. Why should I add it? What's the question you asked and answered that allowed you to come to that conclusion?
It's unrelated to the business generating cash.
In other words, I haven't counted my earnings. The Picassos don't produce cash flow. So when I did my DCF, it's definitely not there. So already you can see the dividing line, right? If you've already counted something, don't add it on. That'd be double counting. If you haven't counted something, then maybe it should be on. But those are going to be odds and ends. They're not going to be central assets, because those central assets are what produce your earnings and cash flows. So let's talk about loose ends. And I'll go back to the page where I left you last session, where I was talking about tying up loose ends. So let me give you a little bit of history while I wait for this again. I don't know why I keep doing this in this class, but I click the presentation mode and goes off into. So I'll give you a little bit of history to this loose end section. So there we go back again. Do you guys familiar with how academia works? How professors? I'll give away the inside story. Now, you know how hard I work? I have to teach like 4.5 to 5 hours a week. It's really stretching my resources. And I get only summers off, like 15 weeks. And so basically I teach like 31 weeks, 5 hours a week. I get like 20 weeks off. And because I work so hard, every 7th year, I get the entire year off with pay. It's called getting a sabbatical. So you guys are already feeling sorry for me, right? 5 hours a week, real toil, and then only 21 weeks off, 7th year off with full pay. Don't let any professor tell you how difficult their life is. They're lying. There isn't another job in the world which is this cushy, but we get away with it. So this was about 15 years ago. I was due for a sabbatical. I decided to take it. And my plan, people in this take sabbaticals, they have big plans. They're going to write a book. They're going to do this. They're going to do that. My plan for my sabbatical is very simple. I want to do absolutely nothing for a whole year. Nothing. I wanted to wake up every day with a to-do list with nothing to do. So first day of my sabbatical, I decide to do this. And I'm a little over the top about it. I went to Staples and I got one of those, you've seen those to-do lists you can get on a board you can hang on the wall. I bought one of those. I brought it home. I put it above my little desk at home. And that morning as my kids are all at home still, all 4 kids, they come down to go to school. And as they come down, I point to my list and say, look, I have nothing to do today. Piss them off no end. But they went off to school. And then I made my fatal mistake. My wife came down the stairs and I said, "Hon, I have nothing to do today." She said, "Really? Why don't you take the dog for a walk?" I take the dog for a walk. I come back. There's something on my to-do list. It says, "Pick up bok choy at the grocery store." I'll make a confession. I have no idea what bok choy even was. I walk to the grocery store. I'm too embarrassed to ask. I wander around for an hour. I finally find it's like ugly looking cabbage. And I come back home. It's the second to-do on my to-do list. Pick up kids at school. And after about the 7th or 8th item on my to-do list, I say, you know what? I've got to find things to do just to keep her off my list. So I'm desperate. And I get an email from the editor of CFA magazine. I'll make a confession. I didn't even know there was a magazine called the CFA magazine. I'd never heard of this guy. But he called and said, "Would you write an article for CFA magazine?" My first reaction would have been, I'm on sabbatical. I want nothing to do. But then I remembered I needed things to do to put on my list. I said, okay. And then I wrote in big letters, write article for CFA magazine, cannot pick up bok choy kids, et cetera, et cetera, et cetera. And then I wrote an article. It took me a couple of days. And it's the only thing I've ever written in corporate finance evaluation that's got me hate mail. You know how difficult it is to get hate mail in corporate finance evaluation? People don't feel strongly enough to hate you. Nobody's ever sent me an email saying, "I hate you for using bottom-up betas," or "I hate you for using implied equity risk premiums." But this particular article got me hate mail for a couple of reasons. One was the title. It said, "Stop the garnishing." And I was talking about the practice in valuation where people value a company and then they garnish. By doing what? Adding 20% for control, 30% synergy, knocking off 15% for liquidity. I said, you got to stop this, because if you do this, you're going to end up where you want it to be, and the whole point of valuation is lost. And during the course of writing the article, I might have used the word arbitrary to describe some of these premiums and discounts, which people didn't like. So I get a wave of hate mail. No. And one of the emails I get actually cuts to the point. It said, if you don't like the way we're dealing with control and liquidity and valuation, which you don't seem to, why don't you come up with a better way of doing it? Which I thought was a legitimate complaint. I said, you know what, you're right. I have 11 months left in my sabbatical, and here's what I'm going to do. Each month, I'm going to pick a loose end. And I'm going to spend the entire month thinking about how I would value it. First month I spent on control, second on liquidity, third month on employee stock compensation, which kind of defeated my initial objective of doing nothing for a year. But by the end of my sabbatical, actually it became one half of one of my books, The Modern Valuation. The second half of that book is basically those loose ends. And I'm going to take you through a kind of compressed journey of what I did over those 11 months. And here's some of the things we're going to talk about. We're going to start with a very simple thing. Early in this class, we talked about cash. And I said, if you have 100 million in cash, don't play games. It's worth 100 million. Today, I'm going to start out with a more provocative question, which is, you see 100 million in cash in the hands of a company. Are there conditions where you might discount the cash in the hands of that company? And if so, why? And are there conditions we might attach a premium? I'm going to argue there are, and we're going to talk about why. Then I'm going to talk about cross-holdings. You already saw the mess you get with majority, minority. In a perfect world, how would you value cross-holdings in the world we're in? With the kind of data we have and information we have, how do you value cross-holdings? Then I'm going to talk about other assets. What else should I be adding on? We said we shouldn't count brand name and headquarters building. What should we be adding on? I'm going to give you a couple of examples of other assets you want to bring in. With debt, I'm going to open the door, because now we're talking not about the debt that goes into cost of capital, but the debt that you subtract out to get to value of equity. You're saying, why would the two be different? There are items like underfunded pension obligations, underfunded healthcare obligations that show up as liabilities that you don't treat as debt for cost of capital, but you need to subtract out to get to value of equity. I also want to talk about employee stock compensation. 20 years ago, this took the form of options primarily. Increasingly, we've moved away from options to restricted stock. I want to talk about why that affects the value of your equity and how to bring it in. So we've got a lot on our plate. Let's get the process rolling by starting with cash. I told you that, that You shouldn't be punishing cash for the wrong reasons. But let's face it, cash gets mixed in with other assets. So when you look at things like net income, the equity income from cash is in there. When you look at book equity, cash is already in there. So cash is all over the place. And you're not careful, you can end up doing some very strange things to cash. Let me give you an example. When you compute free cash toward equity, you start with net income, right? Net income already includes the interest income from cash, which is technically riskless and it should be discounted at a low rate of return. But because you're looking at free cash toward equity, you tend to use a cost of equity, which is much higher. You're messing up cash. That's why when we do value the firm, we keep cash separate. We take the operating income and the operating cash flows, we discount the cost of capital, and after we're done, we bring in cash. So here's what I'm going to do. I'm going to show you 3 companies. Okay? And I very creatively named them A, B, and C. The 3 companies have the exact same enterprise value of operating assets, exactly same cash balance, 100 million. But here's where they're different. Company A is a US company, and its history is that it's earned a return on capital roughly equal to the cost of capital. Company B is also a US company, but its history is it's earned a return on capital well below the cost of capital, 5% versus 10%. Company C is an Argentine company, and it's earned a return on capital of 22%, and its cost of capital is 12%. So 3 companies, they all have 100 million cash. I'm going to argue that in one of these 3 companies, cash is a neutral asset. You know what I mean by neutral? 100 million cash is valued at 100 million. In one of these 3 companies, cash will be discounted, and in one of these 3 companies, cash might actually trade at a premium. Ritik, I'm going to put you on the spot with the easy question. In which of these 3 companies is cash most likely to be a neutral asset, and why?
Would it be company A?
And tell me why. You're right. What is it about company A that makes you feel pretty sanguine about the use about them having cash? What have they done historically?
Their return on invested capital is the same as their cost.
This is the kind of company I call a block company. You know what block companies do? They don't hurt you, they don't help you, they kind of stay in place. So management of this company is not doing you any harm, so they have 100 million cash, you feel pretty okay about it. Madhur, which of these 3 companies would you discount the cash, and why?
I would probably discount the cash for the Argentinian company just because it's such a volatile country, such a volatile currency.
So you're punishing the company for being in a bad country. Let's set the Argentine. Maybe that's I made a mistake by making it Argentine because your predispositions about countries are coming into play. Okay. We'll come back to company C, but what is it about? Anybody want to give me a different company that they would discount? Aum, would you agree with Madhur that you would discount company C?
I would choose to discount company B because it's
And what is it about company B that troubles you?
Oh, well, historically, its return is less than its cost of capital. So
they have a history of stupidity. You know what? You're attaching a stupidity discount. Why are you attaching a stupidity discount? You give a stupid management $100 million. What are they going to do? They're going to find other stupid things to do. And you're in advance discounting the value, saying you're going to find a stupid thing to do, a big acquisition you shouldn't be doing, and I'm going to reduce the value. Let's talk about company C. It's in an emerging market, right? Why do you think I made it Argentina? Because in the last 20 years, Argentina has had at least 5 episodes where capital markets have shut down. You know what I mean by capital markets have shut down? You can't raise equity, you can't borrow money. And as companies see, if you trust their accounting, does it look like they're a pretty good company? They're earning a 22% return on capital. It looks like they're in a pretty good business, right? What is the advantage of having a cash balance in a company where capital markets can shut down? A, it lets you survive that next crisis, which is coming 2 years from now, because you can use the cash to survive. Second, in a crisis, everybody else is selling things for cents on the dollar. They're desperate for cash, and you can use your cash to buy those assets. Do you see where I'm going? Company B, I'm going to discount the value of cash because I don't trust the management. In company C, I might actually attach a premium to the cash, not just because they earn more than the cost of capital, but because they're in a capital constrained environment where you cannot raise capital. So in none of these companies did I factor in what returns you make, because as we said, comparing the returns you make on cash to cost of capital or cost of equity is a non-starter. That's crazy. It doesn't make sense. Because cash is riskless and liquid, and it should earn a lower rate of return. I'm not punishing company B because it's holding cash. In fact, I'm punishing B because of what it will do to the cash or invest the cash in. If it left the cash as is, I'm okay. In fact, that's my best case scenario. Now, this sounds incredibly abstract. You're saying, would companies actually, would the markets actually do this? Would they actually discount a company's cash balance because they don't trust the management? It's one of the most fascinating studies I read. It's about 20 years ago. Somebody decided to ask this question and answer it for US companies. And here's what they did. They took all US companies and they asked a very simple question. How much is $1 in cash valued at in this company? I'll give you the good news first. Across all US companies, $1 in cash is valued at roughly $1. You know why that's good news, right? Because that's what we do in every DCF. We add the entire cash balance, and the study seems to say that's okay. But before you move on, they did find something interesting. They found that if you focused in just on mature companies, which earn negative excess returns, you say, what does that mean? Companies like Company B. $1 in cash is valued at 69 cents. That's an astonishing discount. You have a $10 billion cash balance, but you have a bad history. Here's what I do. I act like you have only 6.9 billion. I might have said this about Carl Icahn before, but I'll say it again. When people like Carl Icahn are not that deep. I've seen Carl Icahn say some incredibly stupid things about corporate finance and investing. But you know what Carl Icahn brings to the table? He targets the right companies. It makes why I brought in Carl Icahn. You take that company with 10 billion in cash, and the market acting as if you have only 6.9 billion. Let's say you're the manager of this company. What's the easiest way to make this discount disappear? Emily, you want to try? I have a $10 billion cash balance. The market's acting like I have only 6.9 billion, and I want that discount to disappear. What's the easiest way to make it disappear? What should I do?
Maybe invest in something that's going to have a higher return.
But in a sense, my history means I'm in a bad business. I'm having real trouble doing that. That's going to take a lot of work. And even if I did it and I told the market I've done it, they're probably not going to trust me anyway, because given my history, they're going to say, why should I trust you now? So that's going to be, you can try, but it's going to be difficult to do, right? There's something even simpler you can do. What's the source of that problem? That you have this cash, right?
Mm-hmm.
What do they worry you might do? Stupid things with the cash. Could you get rid of the cash? What could you do?
Invest.
Paying a dividend or giving it back to the stockholders. The minute I do that, the cash goes away, the discount goes away. Now do you see, but managers will refuse to do it because they say, we've changed. I mean, Emily, that's exactly how managers, we've changed, our projects have become better, let's try this. And the market doesn't trust you. You know where Carl Icahn comes in, right? What does he do? He buys shares in your company, and right after he buys the shares, what's the first thing he pushes you to do? Give the cash back. You've made life really easy for the Carl Icahns of the world by having this cash balance and not doing anything about it. So the next time you see a company targeted by an activist investor, look at the history. Look at the cash balance, then look at what the activist investors are pushing for. And you're very quickly going to start to see the pieces come together. So you're saying, how is this going to play out when I value my company? Don't change anything about the way you value a company. Take cash flows, discount the cost of capital, come up with the value of the operating assets. You'll have a cash balance, add the cash balance. But what I'm saying is if you have a company where a big chunk of its value comes from the cash balance and investors don't trust the company, it is entirely possible that you might find this company to be undervalued. But it's undervalued not because investors don't understand the operating business, it's because they don't trust the managers of this company with the cash. And that discount will not disappear until the cash gets returned, right? It's not something you fix easily. it's got to be returned. Any questions about cash?
Real quick, Professor, I have a
Yes.
question. How do you go about finding out what the market values just the cash at? Like, how do you isolate?
You're saying, how did they study? They actually did a very, very, very creative test. They took every company's market cap, which you can observe. They took every company's cash balance. And they would throw in a bunch of variables. We know market cap should be higher if your earnings are higher, if you're earning higher returns, but they threw the cash balance as a separate variable in a regression. And they ran a regression of market cap against the cash balance. And they looked at the coefficient on cash. You're saying, what is it going to tell me? If $1 in cash is being valued at $1, the coefficient will be close to 1, right? Because the cash will feed, because the cash should just feed into market cap. So when they broke companies down by looking at the coefficient, they could tell what the market was attaching. And for mature companies, the coefficient was 0.69. For high growth companies with great excess returns, it was 1.22, which basically meant that for those companies, markets were valuing $1 in cash at well below $1 for mature companies and well above $1 for growth companies.
So on an
So it's
individual
actually an
company,
easily doable study because of that reason. So that's how they came to that conclusion.
okay. So on an individual company basis, like for our companies,
You
we
can't
would do it
right?
just by,
All you can do is, but you can look for clues, right? What drives trust? I mean, think like as a shareholder. Why
like
do we
return on
trust the
capital?
managers of Google? You look at their history, and the history is they've taken great projects, they've delivered great returns. And I think that's the thing you look at. You look at their history, and while they might have changed, the history kind of drags on them if they have a bad history. So now let me make a detour. Now that we know what drives this discount, I'm going to use this to talk about something that people in finance have noticed as a puzzle. You know how a typical mutual fund is structured, right? So when you decide to invest in the Fidelity Magellan Fund, you send $10,000 into the fund. You know what happens? The number of shares in the fund will expand, and your net asset value will just be the value of the stocks that Fidelity Magellan has divided by the number of shares. So when you invest $10,000, you get $10,000 worth of shares. That's a typical mutual fund. It's called an open-end mutual fund. But there is a subset of mutual funds, a small subset, which are called closed-end funds. The closed-end fund, here's what you do. You buy shares in a company, right? So you buy shares like in any other company. The company invests only in marketable securities in other companies. So basically, so you put $100 million in the company. This company goes out and buys Apple shares and Google shares and Tesla shares with your money. So every asset on this company's balance sheet is a traded stock, and there's a market price for the stock. This should be the easiest of all companies to price, right? So let's assume we have a company which has $100 million in securities as its assets. What should this company trade for roughly? Roughly $100 million, you know. In one of the great mysteries, and we're going to see in a minute why the mystery can be untangled, one of the great mysteries in finance, a typical closed-end fund trades at about a 15% discount on its asset value. And this isn't some obscure book value. So you have $100 million worth of stocks, but the market is pricing you at only 85 million. So Shaurya, you're going to help me out here. You see this closed-end fund. It's trading at 85 million, but it owns stocks that right now in the market you could get 100 million for. This seems like easy money to me. So tell me a way in which you could capture that $15 million difference. What could you do?
Oh, I'm not sure.
Can you buy shares in the closed-end fund? It's publicly traded, right? So if you buy the shares, how much would it cost you to buy the whole company? 85 million. Right after you buy all the shares, you now control the company. You control a company, can you liquidate a company? Absolutely. You liquidate the company, you sell the shares. What should you get for the shares? 100 million. This seems like 15 million of easy money, right? And that's what made it a mystery. How come you have closed-end funds where you know exactly what they own, and why would they trade at a discount? There are practical reasons why you might not be able to pull this off. Here's the first one. If I own 100 million of shares in less liquid companies, trying to sell them, I can affect the price, right? But if I own shares in Apple and Google, I'm clearly not affecting the price. You're saying, what will hold me back then? Let's say you bought your Apple and Google shares 10 years ago, and you're selling them today. After you sell the shares, what's the next thing you have to do before you clean out the company? You've got capital gains. You've got taxes on those capital gains. You're a corporation. You got to pay taxes before you pay it out. In other words, that 15% discount might not be enough to cover the taxes, the transactions cost. So what I'm trying to say is, look, closed-end funds trade at a discount. They're not easy money. That's why they continue to trade. But there's a bigger question. If you look across closed-end funds, it's true. The typical closed-end fund trades at about a 15% discount, but about a third of funds, closed-end funds, actually trade at a premium. And there are funds out there that trade at 30 or 40% discounts. And people say, why is it so different? To understand why, I'm going to create a closed-end fund. And Tim Park, you're going to be my helper here. So I create a closed-end fund. I've been running this closed-end fund for a long time. And I have a history of delivering 0.5% less than what I should be. So given my risk, let's say I should be making 11.5%. I consistently deliver 0.5% less. So you're investing in my fund. Can you use those numbers to actually figure out how much of a discount this fund should trade at? Let's suppose you invest $100 in the fund, go from there. So what happens?
I'm not sure.
Okay. So you invest $100 in the fund, they make 11% a year. So that's $11 a year, right?
Yeah.
You make $11 every year. What do you need to make? 11.5% given the risk.
Mm.
The value of this fund is then going to be the $11 discounted back at 11.5%. So if it's a perpetuity, $11 every year forever at 11.5% discount rate gives me like $96.
Yeah.
So you know what? This fund is going to trade at a 4% discount. Why is it trading at a 4% discount? Because I earn 0.5% less than I should have.
Yeah.
If I earn 1% less, that discount will become 8%. If I earn 2% less, it'll become like 15%. You know what the average mutual fund underperforms the market by? Roughly 1 to 1.5%. In a closed-end fund, that's going to show up typically as a discount. You think, then why is some closed-end funds trading at a premium? Well, if you earn more than you should make, earn more than what the market says, it shows up as a premium. So if you're a really good money manager, how do I reward you? I pay a premium. So to me, there's no mystery here as to why closed-end funds trade at what they do or why they continue to exist. But I'm going to show you the most famous closed-end fund in history. Now I tell you the name of the closed-end fund. You're going to say, no, that's not a closed-end fund. You heard of Berkshire Hathaway, right? Berkshire Hathaway is Warren Buffett's company. It's his investment vehicle. And Berkshire Hathaway is an insurance company on one hand. The insurance company Berkshire Hathaway owns is, of course, Geico, one of the best-run, largest insurance companies in the country. Now, typically, here's how insurance companies work. They go out and they sell insurance, and then you start paying premiums. So if you buy, a homeowner's insurance, you send me premiums. And as long as your home doesn't get broken into or burn, I just get to keep the premiums. But as an insurance company, I collect those premiums and I invest them while I wait for claims to come in. I invest them in stocks, I invest them in bonds and securities. And a typical insurance company, the value comes from their insurance business, their capacity to charge the right premium, assess risks right. They don't really pick stocks that well, so the investment side is kind of neutral. But Geico is an insurance company whose money manager has been the most famous stock picker in history, a guy called Warren Buffett. So what you have is an insurance company collecting capital, and Warren Buffett then picks the stocks to invest in. So guess what investors have historically been willing to do? They pay a premium. Why are they paying a premium? Because you have a closed-end fund that's investing in great stocks. You attach a premium to it. And that premium used to be huge. In the late 90s, Berkshire Hathaway traded at a multiple of book value that was almost twice what an insurance company traded at. Essentially, you were paying a big premium because you had Warren Buffett picking stocks for you. You know what's happened to that premium? It's gone. By 2019, Berkshire Hathaway was actually trading at a price to book ratio lower than the typical insurance company. What's happened? Parker, you want to try? What do you think's happened to the Buffett Premium over time? Or why has it why does it look like it's gone away?
Sorry, I just joined the class after interview, so my brain's not functioning.
Kumar, you want to try? Why is the Buffett Premium almost gone?
Is it just like general market sentiment about his performance?
Yeah, that's one, right? His performance has gotten worse over time. In fact, I wrote a paper on value investing, whether this is the requiem for it, because for the last 20 years, value investing collectively has had trouble, and Warren Buffett's had that trouble too. So that's one. What else? Raja?
I actually had a question on the previous thing you just said.
Okay, I'll come back to that then. Let's
Okay.
deal with this first. Louis?
Yeah, sure.
Is part of it that he's getting very, very old and he's being less active and he may pass away soon?
Mortality is in it. What are the two things you can never beat? Death and taxes, right? I don't want to be morbid, but when you're 92 years old, the clock is ticking. So even if you're a great stock picker, still there's only so many years left. So part of it reflects his aging, part of it reflects his performance, but it's entirely predictable. Berkshire Hathaway now is a really good insurance company with solid but not superstar money management. To expect it to be anything other than that is to be incredibly unrealistic. So all these people who want Berkshire Hathaway to reincarnate itself and become what it was, it's not good. In fact, if they try too hard, they're going to screw this whole thing up. So when you look at a company and you see this premium or discount, that's it. Rajan, now back to you. So what was your question, the previous?
Yeah, you were talking about closed-end funds, and I was wondering how this relates to macroeconomic changes in markets. So if you look at a year which returns are lower or higher than expected, and that closed-end fund sold at a discount, but that
No,
discount
because remember, it's always relative to the market. So the market does badly, I don't ask you to do well. I ask you to do at least, so in a sense, all of these are excess returns. Whether the market is up or down, if you consistently deliver less than what the market is doing, that's going to be factored in the excess return. So it has nothing to do with markets going up and down. It's got everything to do with how you do as markets go up and down.
So even if there's a year where, let's say 2019, I buy a closed-end fund, 2020, that fund does not perform as well as it usually does, and I paid a discount for it, then does the fund suffer in that situation?
Well, the discount stays. So let's suppose that in 2020, your fund made 15%. That's pretty good, right? But the market was up 18%. Your discount will stay. Your overall fund might go up, but it'll still be trading at a discount on the net asset value.
Got you. Thank you.
Sriram?
So SPACs have obviously gotten like a lot of attention recently.
In fact, that's a good point. This is a perfect place to bring in SPACs. So help me out, Sriram. So if you think about a closed-end mutual fund, a SPAC is very much like a closed-end mutual fund in one case, right? Which is SPACs are publicly traded. You buy shares in a SPAC. What makes it different from a typical mutual fund?
It doesn't have anything.
It doesn't have anything. In fact, with a SPAC, here's what you get. They collect the cash, and then what do the promoters of the SPAC tell you? They're going to go find a company out there, and it's very single purpose. Once a company is found and bought, the SPAC disappears. So it's actually, a SPAC is like a closed-end mutual fund, which basically buys one IPO. And you make money on two things. One is whether they can find the right target company. And second is whether they can buy that target company at a low enough price. Remember, the excess returns come from you buying the company at a low enough price and seeing the price bounce up. Bill Ackman started a SPAC, right? So this was recent. Why would you invest in a Bill Ackman SPAC? Bill Ackman was one of the best performing money managers in 2020, and he's had a long track record of doing this in Pershing Square. So why are you putting your money with Bill Ackman? Because you're trusting that Bill Ackman will go out there and not only find a good target company, but negotiate a good price. So you might actually pay a premium. So when the face value of the SPAC, remember, right after the SPAC is done, there's an amount of cash in the company. That's all they have. But the SPAC will trade at a premium on that number if you think they can pull it off. So Bill Ackman's SPAC trades at a premium. The typical SPAC actually right now is trading at a slight discount on the cash. So what does that tell you already? In spite of all the buzz you hear about SPACs, investors are being pretty realistic. They recognize that by the time the founder takes his cut or her cut and finds you a company and buys it and negotiates a price, it's not going to make what you'd have made just putting your money in an index fund. And let's face it, everybody and their brother and sister is starting a SPAC. Chamath Palapatya, you probably track him, he started with A. He's now halfway up the alphabet. He has like 12 SPACs. He says, I haven't thought about a company, but so easy to start a SPAC. What's Chamath's history? He started at Facebook, he was a pretty obnoxious employee, but he was very smart. Then he went on and made a lot of money on Bitcoin. He's never run a business. Presumably you're buying is because he can time it right. Maybe he can buy the next, because all you need is to get the timing right. But how the heck do you explain Colin Kaepernick starting a SPAC? You know that Colin Kaepernick started a SPAC? Now, if you and I if we want to debate whether Colin should be signed by the Jets, I mean, let's face it, the Jets can pretty much sign anybody off the street and they will become a better team than they are right now. We can argue maybe Colin's in the right quarter. So, but what the heck is Colin bringing to this game that you would actually put your money with him and say, go find me a private company that's underpriced? That's the part of the SPAC process that's gotten out of control. And what you're going to see is start to reflect. You're going to see SPACs trade at big discounts on face value as you start to see mistakes being made by SPACs. But a SPAC is just like a closed-end fund. But it's scarier because you don't know what they're going to invest in at the time you invest in. So it's based on the perception that this promoter, this founder can find you a good deal. Which brings me to Crossholdings. And let me set up the picture for Crossholdings. There are three ways in which Crossholdings can be accounted for. You can have minority passive holdings. So when you own 2 or 3% of a company, take absolutely no role in how the company's run. It's called a minority passive holding. If you have a minority passive holding, here's what you're required to show in your income statement. You have to show the dividends on those cross-holdings, and only dividends. And in your balance sheet, you have to show what you originally invested to get this cross-holding. So it's kind of disconnected from reality. The second are minority active holdings, and most minority holdings are classified as minority active holdings. You own 10% of a company, you take some role in how the company is run. Here's what you're required to do. In your income statement, you have to show 10% of the net income or net loss from that holding. So basically, you show your share of income or loss better than dividends. And in your balance sheet, you show what you originally invested plus or minus the retained earnings since. So it's like an updated book value. So minority active is better than minority passive. That's called the equity approach. But if you get to 55 or 60% of a company, accountants flip out. You own 60% of a company. As I said, accountants require that you consolidate, which makes no sense to me. So as you're doing your revenues, they ask you to act like you have 100% of the revenues. And you say, look, I own only 60%. The accountant says, don't worry about it. You get to the operating income, they count 100%, you own 60%, don't worry about it. You get to the balance sheet, I count 100% of the assets, and I say, look, I own only 60%. The accountant says, don't worry about it. In the last moment, the accountant wakes up and says, but you own only 60%. You say, that's what I've been trying to tell you all this time. You say, you don't own the other 40%? Exactly. And then the accountant says, we have to show the 40% that doesn't belong to you on the balance sheet to tell the world you don't own the 40%. I said, duh. Took you this long to figure it out? And then the accountant invents an item, to me the most misnamed item on the balance sheet, reflect the 40% that doesn't belong to you. It's called minority interest. When you see it in a balance sheet, it'll always be a liability. And it reflects the fact that you've consolidated and you don't own 100% of the company. It reflects the 40% that doesn't belong to you. Now do you see why dealing with cross-holdings is such a nightmare? Because already you can see how accounting deals with a cross-holding can mean very different numbers show up in your income statement, your balance sheet, your statement of cash flows. So Rodrigo, you're going to help me out here. We're going to do a valuation of a company with cross-holdings. And I'm going to kind of feed you the information as we go along. So first step, you sit down, you estimate free cash flow of the firm, cost of capital, you take the present value, come up with a value for the operating assets of $1 billion. Let's say there's no cash, you have 200 million in debt. What's the value of equity in the firm? If I have $1 billion in value of operating assets, 200 million in debt, equity is
800 million.
800 million. So you got that out of the way. And then I said, oh, you know what, Rodrigo, I forgot to tell you that this company owns 10% of company B, and that I can't give you the information, but that company B is publicly traded and has a $500 million market cap.
Plus
so my question is, what do I do about this 10%? You know, I have an $800 million value for equity. I own 10% of another company, which has a $500 million market cap. What do I do about that 10% of 500 million?
You add the 50 million.
And tell me why I'm adding it.
Because your free cash flow computation does not include the
Because I start with operating income, and this is a minority holding. What do we say about minority holdings? They show
Only
up
the
below the operating income line. So I add the 50 million because I haven't counted it yet. And then I'm going to throw another wrench into the works. I tell you, oh, I forgot. Company A also owns 60% of company C, and we were using the consolidated financials when we did the valuation. And by the way, the minority interest that shows up in the balance sheet is 40 million. So final question. So we got from 800 to 850 by adding 10% of the market cap. I've now told you I've done consolidation, and I've told you the minority interest. What do I do with this 40 million? Add, subtract, or ignore?
That is like book value. So you need to subtract the market value.
I'm going to subtract. You say, but you're already pointing out that I'm going all over the place, right? The first step, what did I do? I did an intrinsic valuation of the company. In step 2, I took a market price. I didn't even do an intrinsic valuation. Step 3, I'm taking an accounting value of the minority interest. This is unfortunately how people deal with cross holdings in practice. They mix intrinsic value with market pricing with book value. So Rodrigo, since you brought up the market value, in a perfect world, how would you value B and C? What would you need to do?
So you value company C, and you.
How about company B? Shouldn't I value company B too? Because there's a market price, which might not be the true intrinsic value.
Oh yeah, so you value both companies, and for company B, you add 10%. For company C, you count only the 40%.
You subtract out the 40%. In fact,
yeah, so
let's say I'd done an intrinsic valuation of B and C, and I'd come up with 250 million for each. I'd start with the 800 million. I'd add 10% of the intrinsic value of equity of B, which would be 10% of 250 million. That'll bring me to 825 million. And then I'll subtract out 40% of the 250 million that I attached to the value of C. And that would give me 725 million. Think about that. I mean, think about how messy that process is. I've been teaching cross holdings now for 30 years. In quiz 2, there's always a cross holding question. In 30 years of quizzes, this is the question that people get wrong the most. Of all of the questions asked in valuation, this is, and you can see why. Do I add? Do I subtract? Do I ignore? Do I add? Do I subtract? Do I ignore? And my suggestion is go back and ask the question, have I counted it already? If I have counted it already, then I should ignore. If I've overcounted it, I need to subtract. And if I've not counted it at all, then I should add. And that's a rule and it's tough because it basically means that in a perfect world, you're trying to do intrinsic valuation, not just of the company, but of every subsidiary. So I'll tell you what I would do in a perfect world. Yeah, go ahead.
So in companies with like multiple class structures of shares, how is
that's a separate issue, right? That's got nothing to do with cross holdings. That's how you allocate the value of equity across 2 or 3 different classes of shares. So let's say I got let's suppose I come up with the 725 million as my value of equity in the company. And you have 2 classes of shares. 50 million voting shares, 50 million non-voting shares. Right? So if I add the 2, I have 100 million. I could divide the 725 by 100, but then I'm giving the same value per share to both classes. What does your instinct tell you? Which class of shares should trade at a higher price? The voting shares or the non-voting shares?
The voting shares.
Okay. And one of the things we're going to talk about is how do you come up with that difference, right? Because this is a question that it doesn't change the overall value of equity. It's how we allocate the value of equity between voting and non-voting shares. We'll come back to that because I think we need to have a few more pieces, but that's separate from the cross-holdings. It's got nothing to do with it.
My question was more like, in accounting terms, if you own enough voting shares to control a company, but you don't own the majority of, I guess, total equity in the company, is that considered consolidated or minority interest?
Consolidation doesn't even require 51% control. Okay, the defining rule for consolidation is if you effectively control a company. In other words, you have 3 directors on the board, you get to hire the CEO. You're required to consolidate. So basically the answer there is you own 51% of the voting shares of a company, you're effectively running the company, the accountant will ask you to consolidate. So so in a perfect world, here's what I would do. I'd value the parent company, not the consolidated company, but the parent company standing alone. Then I'd value each subsidiary separately. So in the example that I gave, I'd value B separately and C separately. And then I'd take the parent company value plus 10% of company B plus 60% of company C, rather than deal with this mess of minority interests and mixing together 2 companies. It's a lot of work, but if you're doing a true intrinsic value, you need to do this. So let me take you back to, I think, 2014, when I valued Yahoo. Okay? You guys familiar with Yahoo, right? In 2014, I decided to do an intrinsic valuation of Yahoo. So I started with Yahoo's operating assets. And what was the primary operating asset that Yahoo had in 2014? What was its business? It was a search engine that nobody searched on and a mail program that nobody used. Basically, it was a company that was being devastated by what Google had done to it. So I said, you know what, I'm going to still try. I put my optimist hat on. I projected the earnings, the cash flows, and I came up with a value for Yahoo's operating assets of about $7.4 billion. So basically, I did a free cash flow, cost of capital, add cash, subtract out debt, $7.4 billion. I'll give you a shocking number. At the time that I did this valuation, the market cap for Yahoo was in the high 30s, 37 billion, 38 billion, and I'm getting 7.4 billion. There must be something I'm missing, right? You know what I was missing? 2 cross-holdings. One was a 35% holding that Yahoo had in Yahoo Japan that was actually a standalone publicly traded company. For whatever reason, the Japanese still seem to use Yahoo to search for things. That company had a value of closer to 18 billion. So if I add the cash, subtract out the debt, and take the 35% of that, I get another 7.3 billion. So let's see where we are. We have 7.4 billion from the operating assets, 7.3 billion from the 35% of Yahoo Japan, and I'm not quite done. Yahoo also happened to own 21% of Alibaba. This was right after Alibaba had filed its prospectus. You know that Yahoo was one of the first venture capitalists in Alibaba? That's how Yahoo and SoftBank were the big initial venture capitalists. Yahoo owned 21%. And this was right after this was right after Alibaba had filed its prospectus to go public. I took the prospectus and I did an intrinsic valuation of Alibaba. And here's what I got. I got 127 billion as the value of the operating assets. And 21% of Alibaba adds another 32 billion. So here's what we have. 7.4 billion from operating assets, 7.3 billion from 35% of Yahoo Japan, plus 32 billion from Alibaba. This was, I did this about a year and a half after Marissa Mayer had been hired as CEO of Yahoo. If you remember the story, Marissa Mayer used to be one of the top executives at Google. She got hired by Yahoo because they wanted her to turn the company around. In fact, her mission was to be the next Steve Jobs. Steve Jobs was at Apple 13 years ago, change Yahoo. And I wrote a post that many people thought was very negative. I said, there's no way she can do it. And here's why. How much of Yahoo's value comes from its search engine? Even if you believe the intrinsic valuation, it's about what, 20%. Marissa Mayer controls the rump of this company. On any given day, you know what drives the value of Yahoo? What Jack Ma does at Alibaba has a much greater impact on Yahoo than anything Marissa. It's not because she wasn't trying. So when she bought Tumblr for $1 billion, good, I'll give you credit for trying, but there's nothing you can do. You cannot move the needle because it's out of your control. This is an intrinsic valuation to Crossholdings. And I was able to do it. Why? Because I had publicly traded, all three companies had their own financials. I was able to do a valuation of each one. But here's the challenge. To do this, I need full financials. And this takes a lot more time, right? To value one company, I have to value three. Let's say, what if I'm in a hurry? Well, you can settle for an approximation. Like what? If you know the book value of a cross-holding, let's say it's 40 million. Remember the example, the minority holding was 40 million? And I told you this is a chemical company. And I also told you that chemical companies typically trade at twice book value. You know what a simple approximation would be? To take the 40 million, say that's book value. I'm going to multiply by 2. I get an estimated market value of 80 million. You think that's so sloppy. I agree. But it's quicker, right? And if your subsidiary is publicly traded, of course you're going to try to cheat and take the market price and just use it because you're saying, look, I have a market price. Why would I go start from scratch? In the case of Yahoo, I would not. And here's why. If I just take the market price of Alibaba and feed it through, then if market is wrong in Alibaba, I'm going to be wrong in Yahoo as well because I've fed that mispricing into the valuation. But actually in the same post where I valued Yahoo, I also priced them. You're saying, what's the difference? In valuation, what do? We project cash flows. We come up with an intrinsic value. In pricing, we just apply a multiple. I use the EV to sales multiple. And here's what I did. I valued Yahoo's operating assets by using an EV to sales ratio. I valued Yahoo Japan by applying a multiple and valued Alibaba by applying a multiple. The value I got was actually surprisingly close in the both approaches, but you can see it's much faster. I don't have to do a full-fledged intrinsic valuation. I'm putting in a pricing. So here's the bottom line. In a perfect world, you would love to do an intrinsic valuation of each subsidiary, but we don't live in a perfect world. And to show you how far away we are from a perfect world, let me tell you a story. This was about 20 plus years ago. I was actually valuing a Japanese company. It was the second or third edition of one of my valuation books. And Japanese companies in the 90s, you always teetered on the edge of disaster because the risk-free rate in yen was so much lower than the risk-free rate in every other currency that if you're not careful, your valuation kind of blew up on you. Says, I'm careful, I finished the valuation, I'm patting myself on the back for a job well done. When I keep reading the annual report and they tell me they have 226 cross-holdings. My task is laid out for me, right? Because if I'm a careful, analyst, what should I now be doing? Valuing 226 other companies in order to get a value. There's no way I'm even trying to do that. But even if I'd wanted to do that, I couldn't have because 166 of these cross-holdings were in private businesses and there was zero information provided about these, no revenues, no operating income, nothing. So I remember I called the investment relations officer of this company. She's a very daunting Japanese lady. And she said, what do you want? And I said, no, I'm valuing your company. It's not for an expose, but I need some information in your cross-holding. She said, I cannot give you that information. And I said, why not? She said, it's proprietary. The way she said proprietary was kind of scary. But I said, what if I bought 1,000 shares and called you? Because she said, still be proprietary. I said, that doesn't make any sense. I'm part owner of the company then, and you're refusing to tell me what I own? She thought about it for a moment. She said, you have a point, but it's still proprietary. At this point, I'm banging my head against a brick wall. I get ready to hang up the phone. She says, I do have something useful I can tell you about these cross-holdings. And I said, what, maybe expecting some revenues or operating income? And she said, I cannot give you specifics, but I have to tell you that these cross-holdings are worth a lot. I said, let me get this straight. I'm entering LOT into my Excel spreadsheet. It seems to be coming back with an error message. How many zeros are there in lot? That cuts part of the cross-holding culture, right? What do managers do? They hold up a brown paper back to you and say, trust me, it's full of cash. I said, can I look in the back? No, just take my word for it. And that's effectively what we're doing with companies with cross-holdings. We're taking the word on what cross-holdings are worth. Why would they ever let you look in the bag? If you're valuing an Asian company, a Latin American company, or even a Spanish company, be ready for a lot of cross-holdings. They're the rule rather than the exception. Try valuing a Samsung. You're going to get a bunch of other Samsung companies in there. Try valuing a Tata Motors. You're going to get a bunch of other Tata companies in there. It's more the rule than the exception. You have to get comfortable doing the best you can with limited information. So we've dealt with cash, we've dealt with cross-holdings. Let's mop up. What I mean by mopping up is you're looking around and say, is there anything I've missed? And remember the rule, you cannot double count something. So here are things that people used to use. For instance, in the late 90s, a lot of US companies had overfunded pension plans, which means they promised defined benefits, but they invested in the stocks had done so well that there was overfunding, too much money. And people would count the too much money as part of equity, saying that belongs to equity investors. That's stretching a little bit. But what you're looking for are truly vacant assets, things you haven't counted. You're saying like what? I'm going to tell you a very offbeat story to kind of illustrate the kind of asset that we're talking about. You've heard of the Michael Price Fund. It's actually a fund that was funded. It's at Stern. Michael Price gave, I think, $10 million to Stern. This was about 20 years ago. And it's a fund run by MBA. So basically they use the fund, they try picking stocks. So they've been running it for about 20 years. So if you go to the Stern website, you can actually see the history of the fund. I've never officially been involved with the fund, but almost everybody who works in the fund, because they're a second-year MBA, has gone through my class. And the way the fund works is when you want the fund to invest in a company, you have to make a pitch to the other people who run the fund. I think it's run by 5 MBAs. You've got to make a pitch to the other 4 about the stock. And if they like your pitch, they will invest the fund in that stock. So guess who they try the pitch on before they try it on their group? So they always show up in my office. Like, can I try my Michael Price pitch on you? So about 15 years ago, I'm sitting in my office. The second-year MBA walks in. He's part of the Michael Price Fund. He says, I'm facing a conundrum. I very quickly turn to my computer, type in the word conundrum to see what it means. And it turns out he's confused. I didn't know why he just didn't say I'm confused, but it sounded so good. I turned back to him and I said, what's your conundrum? I thought I'd play along. He said, I'm valuing Playboy. And I said, I don't see a conundrum yet. He said, I've come up with a value of 240 million. The stock is trading at 300 million. I said, still don't see a conundrum. Move on. This is not a stock for you. He said, here's my conundrum. 7 times in like 2 minutes, we threw in the word conundrum. He said, there's one big asset that Playboy has that I haven't counted in my value yet. You know what he was talking about? The big asset that he had not counted yet. Effie, you want to try? What do you think he had? What's a Playboy asset that hadn't been counted? Don't say bunnies because that's not it. It's already in the cash flow.
I think it was the mansion that was
it's a Playboy mansion. It's one of the most, if any of you are from LA and you've driven by the Playboy mansion, it's this immense property. And in 2007, when this guy walked into my office, it was worth about 150 million. It belonged to Playboy, the company. And the question he was asking was, should I be counting the 150 million? Technically, it belongs to Playboy, right? So he said, can I count the 150 million? I said, there's a little catch here. To get the 150 million, you got to sell the mansion. But unfortunately, there is an 80-year-old in a bathrobe hanging out in the mansion that you can't exactly throw on the street, right? You know who I'm talking about. The mansion wasn't empty. Hugh Hefner lived there. So he said, what should I do? I said, check out the actuarial tables. He said, what am I checking for? I said, check to see how long 80-year-olds who wear bathrobes, who hang out with 26-year-old playmates tend to live. It's a lot of stress on your heart, but 5 years. And he said, what should I do next? I said, then you take the 150 million, you discount it back 5 years. You can, if you want to be fancy, use a real estate cost of capital if you want. It doesn't really matter. That's a truly vacant asset. And I forgot all about it. And 7 years later, I open up the Wall Street Journal and I see a story about Playboy selling its mansion. You know what they did? They sold the mansion with Hugh Hefner in it. I'm not kidding. They actually sold the mansion with the 85-year-old in it. They sold it to a Greek billionaire who paid $200 million for the mansion with a condition, which is Hugh Hefner would continue to live in the mansion till he died. This is pure icing on the cake if you're a Playboy shareholder, because the day after this happens, two things happen, right? You now have 200 million in cash in your balance you did not have until now, and you've removed an 85-year-old who's getting a little grumpy and a little problematic and put him in the house and said, you take him with you. This is a truly vacant asset. When you're looking for what else should I add on, you're looking for things like the Playboy Mansion. You're not going to find too many of them, but that's what you're looking for. So I'm going to end today with a test. It's a very simple test. It's going to set up what we're going to do next. Right? So I'm going to pick on Andreas. You're going to be my guinea pig for this test. So you're an investor. I come to you with two companies. The two companies have exactly the same numbers, same operating income, same return on capital, same growth rate, same cost of capital. The numbers look the same. But here's where they're different. Company A is in a single business. Company B is in many businesses. Company A is a very simple holding structure. They tell you what they own. You can see what they own. It's easy to see. The Company B has special purpose entities, all kinds of complex instruments. Company A has transparent accounting. You know what I mean by transparent? You read the financial statements. It's pretty easy to understand. Company B has opaque accounting. What's opaque accounting? This is a financial statement you read. You're not even sure what language it's in. It claims to be in English, but it's written by lawyers. Lawyers don't write English. They write some version of English that the only people who understand are other lawyers. So you see the choice here? They have the same numbers, but Company A is a simple company. Company B is a complicated company. Which company would you value more highly?
I would go with Company A because everything's a clear picture and the numbers, would speak for them.
I would too, and I would guess most of you would, right? It seems like a common sense thing to do. But if you open up my textbook, when you start entering numbers into a DCF model, remember the numbers look exactly the same. You know what you're going to end up with? The same value for both companies, which left me with a quandary. Because this was actually something that came up. And I'll tell you why in traditional valuation, we ignore complexity. We make a very dangerous assumption. We assume that what you don't know about Company B will get averaged out if you have 100 Company Bs in your portfolio. But you know why that argument doesn't work? What do you not know about Company B? It's what managers in that company have chosen not to tell you, right? Let me ask you a follow-up question. What do managers tend to hold back? A lot of good news or a lot of bad news?
Always the bad news.
Always bad news. How many accounting scandals have you woken up to where the company says, guys, we made 5 times more money than we told you we did? Have you noticed that when there's an accounting scandal, it's always that you made less money? In other words, if you have things you don't know, and those things are more likely to be bad news than good news, averaging doesn't work out. So this came to the surface in 2000 when I was teaching this class, when a company called Tyco got into an accounting scandal, lost 70% of its value. And while Tyco was melting down, Tyco was a conglomerate that grew through acquisitions. While Tyco was melting down, GE lost 15% of its value. And I remember somebody in the class saying, why is GE dropping if Tyco is a company with the accounting scandal? You know what GE was dropping? You know how Tyco was able to hide the accounting scandal? They used acquisitions, they used the fact that there were multiple businesses to hide all the problems. And investors were saying, GE is a conglomerate, it grows through acquisitions. How do we know that GE is not doing the same thing? And we all collectively agreed that valuations, to be more realistic, we have to bring in this complexity somewhere. And I agreed with them and I said, you know what? If we want to do this, there are 2 things we need to do. First, we need a measure of complexity. We can't just say we'll know it when we see it. We need to measure complexity. And they all agreed. And then I said, once we measure the complexity, we have to find a number in the valuation to bring it into cash flows, discount rates. Otherwise, I can't show it in value. And they agreed as well. And they said, what should we, so I asked them, what should we do? And they said, you're the one teaching the class. Why don't you come up with a measure of complexity? And I said, that's fair. I'll be back next week with my measure of complexity. And that's where I'm going to leave you. When I come back next week, I'm going to show you the first measure of complexity I showed them. They were not impressed. Okay? And then we'll talk about more elaborate measures, but that's going to be what will start the next class of measuring complexity and bringing it into value. But I'll sign off with that. I'll see you next week. Talk to you soon. So let me stop my share. If you have any questions, just hang around and keep asking the questions. Yeah.
Thank you, Professor. Have a good day.
Thank you.
Thank you, Professor.
Thank you, sir. Have a good weekend.
Thank you, Professor.
Bye-bye.
Hi, Professor. I had a question on specs where I read that if you liquidate your position, then the existing shareholders, they get leveraged up. How does that work? Or they
get leveraged up? I mean,
their proportional share is
no. When but remember, once you buy shares in a SPAC, it becomes a publicly traded company. So when you sell your shares, you sell it to somebody else in the market. The company doesn't get cash. It doesn't, so I'm not sure where you read that, but once a SPAC gets listed, it's like any other publicly traded company. You're selling shares in Apple, for instance, there's no impact on the company. You're selling your shares in the SPAC, you're selling to somebody else.
I mean, I read that there's like a redemption option where
some SPACs vary. So some of them you might be able to go to the company and redeem your shares, but when you redeem your shares, you're probably going to get, the redemption varies. It could be face value, but that'd be a very daring thing to do. No SPAC I know of does it at face value. But if there's a redemption option, it's usually for SPACs that allow people to cash out, and that does affect the company. Because what it does, it makes the SPAC smaller, right?
Yeah.
So that's why these redemption options usually come with such onerous terms, because otherwise, if enough people redeem, you're never going to be able to do what you set out to do, which is do the IPO at and pay the price you need to. So if there's a redemption option, it might be thrown in there. But my guess is the redemption option is so onerous that it's like most options, you don't make the money by exercising the option. You make it by selling it. So it's in the price, you basically price it in. And my guess is most of the time, you're better off just selling your SPAC shares if you've lost faith in the founders.
Got it.
And trying
Thank
to
you.
redeem those shares.
Thank you.
Professor, I had a quick question about the last thing we just talked about. So couldn't you say that since everything's supposed to be transparent, or at least for the public companies, everything's supposed to be disclosed, like couldn't you say that after
disclosure is not transparency, right? So GE has been disclosing its financials for 30 years. But if I disclose that I'm in 81 countries and I show you all 81, you have the disclosure, but your life just got more difficult, right?
Right.
So complexity can so disclosure doesn't make complexity go away. In fact, you could argue that many of the accounting disclosure rules have made complexity worse. Because they've added stuff that gets now reported that might or might not matter. Part of your job is wading your way through the stuff that doesn't matter to get to the stuff that does matter. So I'm going to argue that accounting disclosure in a very strange way, in a very perverse way, has made companies more complex. So they did it with the best of intentions. They thought if we can make companies disclose, investors will understand them better. But disclosure and understanding are two separate issues.
So is that why you would then discount it, just because you're not sure every time about the information you could potentially?
Or it could be that disclosure makes it much more difficult for me. So for instance, let's say you give me, you say in 72 countries and you say your geographical exposure will change over time. That means when I do my equity risk premium, I can get it right for year one, but I don't know what it'll be in year 3 or year 5. So there's uncertainty about the numbers. Or if you tell me you're a SPAC and you don't tell me what business you're going to do your IPO in, I mean, this is a pig in a poke. How do I know what do I do? You could be a technology, it could be a hotel company, a technology company. So disclosing that is just the first step. Taking the disclosure and putting it into your numbers might be the more difficult step.
But obviously there's still that chance that you might hit the jackpot of that specific company, that even though it's complex, at
the right price. I mean, I'm not saying you wouldn't buy the complex company at the right, at the right price, I would buy the complex company.
Oh, okay.
But I'm just saying upfront, I've got to pay a lower price for the complex company.
Okay.
Otherwise, no, on average, at least the game is set up so I will lose.
Okay. Got it. Thank you so much.
Bye-bye.